Hi, folks. Welcome to another episode of Who Said What. I'm your host, Krishna, and for those of you who are new here, let me quickly set up some context for what this show is about. See, the idea is that I'll pick the most interesting and juiciest comments from business leaders, fund managers, and the likes and contextualize things around them. Now, some of these names might not be familiar, but trust me, they are influential people, and what they say matters a lot because of their experience and background. So, I'll make sure to bring a mix. Some names you'll know, some you'll discover, and hopefully it'll give you a wide and useful perspective. Now, with that out of the way, let me get started. The hot summer that India usually experiences didn't last too long this year, and that's precisely what has made air conditioning companies sweat. In an interview with NDTV Profit, Vikas Gupta, the MD of PG Electroplast, explained what went down. By the way, for your context, PG Electroplast designs, manufactures, and assembles electronic components for other manufacturers.
So, because of the early onset of monsoon and due to the high channel inventory, the overall summer selling season for the air conditioners got compressed and it fell off beyond the anticipation of any of the industry players.
Well, that's a lot. Now let's break down how this dynamic played out. See, in the previous quarter, which is Q4 FY25, AC companies were swimming in soaring sales. PG Electroplast reported a whopping 77% increase in annual sales and around 100% increase in net profit. In April alone, their AC sales jumped by 70%. They believed that the summer winds were blowing heavily in their favor and they could sail through these winds at least until July. So to support that momentum, they expanded production massively by investing in more capacity. PG Electroplast in their con call last year had said that in FY26, their revenues will increase by a further 30%. However, in the Q4 FY24 con call, one of the analysts raised a doubt around these future projections. His question was that Blue Star and Voltas are a bit cautious regarding the near-term demand, particularly due to early monsoon, and they're facing some rising inventory levels at the channel. But we are on the other side pretty much confident, which is reflected in our numbers as well for FY26. So sir, please help us understand what is giving us this level of confidence. Now this doubt has come back to haunt PG Electroplast. Fast forward to Q1 FY26 results, compared to the same quarter last year, net profits got squeezed by 20%. Revenues increased by 14%, far lower than the 30% they expected. The results were so disappointing that PG Electroplast had to lower their revenue projections for the whole year. They simply haven't been able to sell enough ACs because the rains came far earlier than expected. But that's revenue. Why the profit shrunk so much can be traced back to their decision to stock up their AC inventory. Now remember that they spent on increasing their capacity, meaning money spent on more factories, hiring more people, higher rents, but these costs remain fixed. They cannot be reduced by producing less. So if sales fall, these costs will translate into big losses that can't be offset elsewhere. Now their misery doesn't end here though. With higher capacity comes higher inventory. Now, due to falling sales, manufacturers were left with an excess of ACs that they could not offload anywhere else. This increased their inventory costs significantly. Now, recovery from this looks difficult as most companies are lowering their projections for the whole year. They may expect some relief in sales due to the festive season, but the peak season for buying ACs only comes once a year, and this year that peak never arrived. Now, what we can learn from this is that climate change is affecting the Indian economy in truly unexpected ways. It isn't just resulting in hotter days but also more unpredictability in the weather. This throws a wrench into the plans of even AC companies that practically rely on hotter days for their sales. So Partho Banerjee, senior executive of Maruti Suzuki, India's largest car maker, in an interview with ET said this: "It's a chicken and egg situation. Till the time adequate public charging network is in place, customers are unlikely to use electric cars as a primary vehicle." He highlights a very real problem. In 2024, 7.66% of all vehicles sold in India were electric. That's scooters, rickshaws, buses, everything. The passenger car slice is far smaller, around 2.5%. Now he says the problem is simple. Most people aren't ready to make an EV their only car. They charge them at home, drive them for short errands, and keep a petrol or diesel car for anything longer. And unless there's a visible, reliable public charging network, that base won't get much bigger. Now Maruti is trying to tackle it by planning to install chargers across the top 100 cities, but he's blunt. Without that network, EVs will stay the family's other car. Meanwhile, Praveer Sinha, who runs Tata Power, the country's biggest charging operator, told this to Money Control. We have laid the groundwork for a robust EV charging infrastructure across the country from Srinagar to Bangalore. But the penetration of electric vehicles has not happened to the extent we were expecting. Many of our chargers are barely being used. Now, barely being used is polite. Public charger utilization is in the lower single digits, which is why Tata Power has pressed a pause on its plan to expand to 25,000 public chargers by FY28. He said that once EV penetration increases, you will see more and more of our chargers being utilized. And that's the loop. Maruti says more chargers than more cars. Tata Power says more cars than more chargers. Meanwhile, the infrastructure that does exist is well not exactly what it looks like on paper. India officially has around 25,000 public chargers. That's about 1 for every 14 EVs. Now that's a better ratio than Norway where it's 25 to 1. But you see, in Norway, 93% of new car sales are electric. See the difference? Their chargers are where people actually need them and those chargers work. In India, too many are scattered as one-off units instead of clustered in hubs where they'd get real use. Highways are the clearest example. The government has mapped 50 national highway corridors for fast charging stations, aiming for one roughly every 25 to 50 kilometers. On paper, it's a good plan. On the ground, coverage is uneven. Some stretches have chargers bunched at one end, others have long gaps. And even where the chargers exist, they're not always live 24/7. Grid connections are weak in some spots, operators shut down overnight, or the sites rely on diesel gensets that aren't there when you need them. Now the PM E-Drive scheme has set aside 2,000 crores to fund 72,000 public chargers by FY26 with a cap of 10 lakh subsidy per unit. The idea is to put them along highways at metro stations, toll plazas, airports, petrol pumps. But installing them is only half the battle. Charging operators face delays of months just to get grid connections from discoms. They have to cough up hefty security deposits and often deal with outdated transformers that can't handle the load. And even when the chargers are up, price kills the appeal. Public charging costs more than double of what home charging in most cities does. India has all the pieces for EV revolution. Cars, chargers, government schemes, willing buyers. But they are not fitting together. It seems like it is just about making what already exists actually work. You see, Scott Bessent is a rare creature. He's someone from a conventional Wall Street background, and yet he has power in and insight into our new economic paradigm where Trump has smashed a wrecking ball into everything we thought we knew about global trade. Now we don't know how he really feels about any of what's happening, and we don't know if he has any real power to change it. But that's alright. To us at markets, Besant articulates the most coherent, intelligent sounding expressions of what Trump is thinking. If there's any logic to what's happening, you're probably going to hear that logic from Scott Bessent. If there isn't, he'll at least give you something to tear into. Now that's why we are looking intently at a recent interview he gave to Nikkei Asia. You may, for instance, wonder what Trump really has in mind when he puts one of America's highest country-specific tariffs on India. To Besant though, this might be just a negotiating tactic and not a sign that we are being singled out as a pariah state. As he says, he uses it, that is tariffs, for negotiations in foreign policy, just like how he said he wants India to stop buying Russian oil. That said, America's primary adversary is still China. China, he says, is the most unbalanced or imbalanced economy in the history of modern world. To Besant, it presents a unique threat to America. As he says, historically our allies have been our economic rivals and the Soviet Union was a military rival and a very small economy. China is new because it's the biggest economic rival and the biggest military rival. So it's difficult to deal with it. In fact, he paints China as fundamentally incompatible with the rest of the world's economy. As he puts it, it's a non-market economy and non-market economies have different goals. Now what are they? To him, much of what China does is they have employment goals. They have production goals more than profitability goals. That's what he claims America is trying to defeat. But tariffs hardly seem like the signature of a market economy. Now, what's the broader idea around them? Does America really want a return to protectionist world where every country hides behind its own border? Bessent at least does not think so. To him, this is all temporary. The way he tells it, Trump's actually trying to remedy America's inability to manufacture things like it once did. It's a sort of shock therapy to shake things up, but it's not permanent fixture of American policy. As he says it, over time the tariffs should be a melting ice cube. If production comes back to the US, then we'll be importing less. Now, this sounds like a production goal, not a profitability goal to us, but we'll let that slide. That said, as any Indian born before the 90s will tell you, you don't start manufacturing things just because you have import restrictions. So, what's the plan? Put simply, Besant wants to change portfolio flows into investment. See, historically, one of the reasons the American dollar and the financial system more broadly has dominated the world is that everyone always thought of it as a fantastic place to buy financial assets. If you were looking to put your money to work, there were very few other places this attractive. Trump's administration thinks they can instead get people to make long term investments into America's manufacturing sector. Now, what we are trying to do is have more foreign direct investment and continue to make the US the most attractive place not only for portfolio capital but for manufacturing relocation. Now, will that work? We don't know. See, when you buy financial assets, it's because you don't want to closely manage how your money is used. With FDI, however, you have to roll up your sleeves and actually run a business in another country. It's like the difference between sending someone flirty texts and marrying them. Now, can Trump give people enough confidence to actually make the switch? Who knows? That's it for this episode. If you have any feedback for me, please let me know in the comments below. It's a chicken and egg situation. And even when the chargers are up, price keels the appeal. It's like the difference between sending someone flirty texts and marrying them. It's like the difference between sending someone flirty texts and marrying. अरे टेक्स्ट नहीं बोल पा रहा. इतना सही है. वो आंसर कर देते. चलेगा कोई दिक्कत नहीं है.